Good afternoon. Welcome, everyone, to the County Employee Retirement Systems Finance Committee regular meeting. It's February 17th, 2025, and I'll call the meeting to order. First thing, Mr. Bronco, could you do the legal public statement, please?
Of course. This is a regular meeting of the County Employees Retirement System Finance Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Ms. Rankin, can you do a roll call, please?
Yes, sir. Mr. O'Mara,
Here.
Mr. Cheatham,
Here.
Mr. Fulkerson,
Here.
Ms. Pendergrass,
Here.
and Mr. Powell.
Here.
Thank you.
And do we have any public comment today?
No, sir, no public comment today.
Next on the agenda is the approval of minutes for the November 25th, 2024 meeting. Does anyone have any additions, deletions, corrections to bring forward?
Make a motion they be accepted as presented, Bill.
Thank you. And a second. We have a first and a second. All in favor, please say aye.
Aye.
Opposed? Those minutes are approved. Next, we have a presentation. I think I'd like to introduce first David Lindberg from Wilshire. And if he could set this presentation up for us, I'd appreciate it.
Sure will, Bill, and thank you very much. Hi, everyone. Several of you we certainly know well from the investment committee meetings. Nice to meet and greet some of the others in the group here today in the finance committee, but excited to show you what we will walk through today. We conducted an educational session with the investment committee in December and talked through what you'll see referenced as the XTP implementation services. We have two members of this team with us, Ian Leverich and Mark Becker, are here to present. And just to give you a little bit of background on this group, we acquired this group and team within the past year and had spent about 2 years doing due diligence on the group because we were so impressed with what they bring to the table. They have an ability to dive deeply into fees, but not only fees, overall cost structure of investment management agreements, LPA documents, etc., at a literally a forensic level. And I think you'll see that that'll come clear as they present today. But we felt that this is such a fit for what our institutional clients are often looking for and can benefit from. So that is the reason we acquired the team, and they'll walk you through today what they do. And I think you just find us to be very helpful. Feel free to ask questions, and we can continue, through this today and after today as well.
Thank you very much, David, and thank you all. We appreciate the opportunity to be here. It's a pleasure to be with you today. I'm joined by Mark Becker. Mark is a senior member of XTP. He oversees our liquid markets team, but also is the head of data analytics. And I'm Ian Leverich. I joined XTP a couple of years ago this month, as a matter of fact, after spending many years at Abel Noser, which some of you may know as a pioneer in what's called trade cost analysis. So my background was helping allocators measure the traded portion of their managers' portfolio. So what kind of commissions they were paying, what kind of execution costs were they incurring when they were trading on your fund's behalf. And it added transparency that otherwise wasn't present in the process. And what drew me to XTP was the expansive scope and how they really build on those concepts, and not just looking at trading costs, but all the investment related costs and processes that are incurred on an allocator's behalf. And not just that, but the actionable nature of the work. And some of the pushback that we would get on the TCA side was, well, what do I do with this data, and how do I make it actionable? How do we save money based on it? And the tricky part of it was that those costs never really changed quarter in and quarter out. Here at XTP, it's different. So what we're doing now is we're looking holistically at all of the costs and processes that go into your net returns, that come out of your net returns, really, I should say. And we pinpoint places along the value chain where we believe that we are able to improve those processes, lower those costs, and therefore increase your net returns. If we can go to the first slide, or we can move past this slide actually into the second slide. So we've measured over 1,000 managers, 10,000 strategies, over $3 trillion in principal traded. We're looking at over 180 cost components that we have quantitative benchmarks, and we're only compensated when we're able to move the needle and find measurable, explicit savings in your portfolio. So our interests are aligned. We only work with institutional investors. A large public fund like yours, I mean, we could be a really impactful partner in the space. If we go to the next slide, please. So this slide outlines really our unique lane. Now, you have Wilshire and your investment staff that are there to navigate really big strategic decisions, allocation decisions, due diligence on managers to hire. And these are really, really, just big picture ideas. Where XTP fits in is we're on the granular pieces on the margins, right? Are those investments and those allocation decisions that you've decided on, how are they being implemented? And can they be more efficient? And is there any money we can save you on the margins in a risk-free way that will yield increased net returns? So we're focusing on contract governance. We're focusing on the transaction costs, your custody bank, a manager's turnover, any number of things along that go into the cost profile of a manager. And then again, separating signal from noise, where can we improve upon those costs? And then with your permission, we work with those managers or custody banks or service providers to improve their processes. And again, we're only compensated when we are able to generate savings. On the next slide, please. So again, we touch on everything across the whole portfolio. We're able to look at your public and private investments, separate accounts, commingled vehicles. We look at your custody bank, settlement charges, how FX is being handled on the back end of a trade. We look at your fees. We look at all of these costs across all of your allocations and put together this cost profile that we consider the total cost of ownership. And what it does is it recontextualizes a lot of those top line fees that that are very transparent and puts them in a different light, and perhaps and finds places where perhaps we can become more efficient. On the next slide. Thanks, Mark. I'll turn it over to you here. I'm going to talk through your approach and your team's approach.
Perfect. Thank you very much, Ian and David, with a good introduction. Pleasure to be here. Yeah, I think the question is like what makes us different, and it's like what are we doing different? It's like from a data provider point of view. So our process is like we need to collect data. It's like on the collected data, we're doing the benchmarking and the forensic analysis, as David pointed out. It's like we're presenting the results, we're doing the client education process, but where we really add value and what sets us apart from essentially other companies is, it's like that we're drawn towards optimizations and implementations for you. Yeah. So we are not that interested in selling a report, it's like bringing a number to you. Essentially, we're interested in, really saving you money. And this can only be done in, it's like the optimization and implementation work. And this work, for this, we need, it's like the service providers that you have already engaged with. So the asset managers, the custodians, the clearers, the brokers, it's like all of the investment banks that are currently working for. So in the overall value chain, I think, it's like there are reported fees, but what sets apart there is it's like that we're not building on reported numbers from managers and service providers, but we build our own data from raw data, from transactions, from holdings, from everything that we can essentially derive from the systems of your service providers and from the data set there. Then we build trust transparency and really have the performance impact through the optimization and implementation part. Yeah. On the next slide, I think it's a pretty.
Mark, may I just add one thing on that previous slide?
Mhm.
So it's just important to understand our process here. So the way this works is we function as an extension of your staff. Now, as I mentioned earlier, your staff and Wilshire, you guys don't have the bandwidth to get into the weeds like we can. So we function as an extension of your staff, and the only engagement really is sending a letter out to your managers and stakeholders or custody bank, telling them that you've engaged XTP for this efficiency study. So from there, we pick up the ball. We meet with your managers. We have onboarding calls. They know exactly what we want. It's a collaborative effort. We get the data directly from the managers, and then we come back to you with our findings. And then with your permission, we say, hey, well, we think we can improve these. And then we take it to the managers and work with them, outline what we found. Very often they're as interested as the client to find what we found because they want to be more efficient too. And then we work with them to improve, and that could come in many different forms, which Mark will get into later in the process slides. And then from there, once we have an optimization and we're able to yield savings, we monitor it for 2 years, and we share in that success for 2 years, and then we're out of it. So that kind of takes you through the process. It is, we are very complementary to your team's due diligence efforts, your oversight efforts, and it's really focused on areas, again, where natural bandwidth constraints are going to keep your staff and consultants away from. Anyway, continue, Mark.
That was great. Yeah. I think Site7 is a bit more known pictures, like in our process is like uncovering essentially optimization potential. I think we're starting with it's like the known cost. Yeah. But what we don't know is essentially the hidden cost elements that are below the surface. Usually those elements that are it's like that are besides the paid by the besides the management fee. So the first step with the information that we get from your managers and your service providers, we build you a transparent total cost of ownership. And the total cost of ownership consists of the known costs and essentially all of the unknown costs that we that are hidden within the NAV of a certain of a certain strategy. And then what we do is essentially try to minimize, it's like the cost picture and, optimize the total cost of ownership by, negotiating you better fees for the known cost, but also for the unknown costs and, bring essentially the gross and net return as close as possible together. What do we measure? I think that can be seen on slide 8. I think it's very interesting. If you talk about total cost of ownership in public markets, and this is like a specific slide for public markets, the vast majority of like work that we need to do is essentially build up the total cost of ownership by looking at the implicit and explicit transaction costs. This is an area where we do have a lot of findings where we can save our clients a lot of money, especially in complex, strategies where we have a lot of trading, where we have a lot of FX, where we have a lot of clearing activity, everything that is in derivatives. There's something where we unfold a lot of optimization potential. We do look at separate managed accounts, but we also look at the run rates and operational costs of commingled managers. I think that's an area where we have a lot of findings that's currently not the core of it's like internal teams, but also consultants. So that's the part run rate operational cost. Clearly, we look also at management fee and performance fees. The good news is that it's like our database consists of thousands of paid prices across like North American market, UK, but also the continental European markets. And we have a pretty good understanding of it's like what are the pay prices of it's like peer strategies, but also knowing what this manager or service provider has negotiated with other clients for that. We're looking at FX and hedging fees and hedging costs. That's an area especially for international mandates, or if you have hedge funds where we do find a lot of optimization potential. We're looking at clearing costs and collateral setups in the public markets, but also at all of the other sub-asset class specific topics that we may think of. If you do have a convertible bond mandate, for example, there are certain cost elements that are specific to convertible bonds or COCO bonds, it's like that we are able to, measure, benchmark, optimize. That's always essentially the process. While looking at the total cost of ownership, we're also ensuring contract compliance. I think that's a big part of, it's like the business. And as I started out, 20 years ago, I never thought that it needs XTP to do some recalculation on management fee invoices. But I have to tell you that it's like on some of the more complex management fee agreements that we have in public markets, but especially in the private markets, but also custodians, we do find the problem that you haven't been invoiced what you have been negotiated with the manager. Yeah. And so there we find optimization potential. It's not on, it's like every manager that we find something there, but potentially we're finding, it's like 5 to 10% of the agreements, it's like minor or major differences from it's like what we have negotiated already and what was invoiced. Yeah. And topics can range from asset management, assets under management numbers put in wrongly because it's sometimes still a manual process, but also the implementation of the scale was a bit awkward or not 100% correct. American fee scales and European fee scales, it's something that where we find regularly stuff. Ian, would you like to add something here?
I would just say that it's some of the things we find it's not nefarious necessarily. It's just errors in accounting, back office errors. Sometimes things are just not top of mind. It could be if you have a commingled manager where they're the ones that have negotiated their custody fee. It's just a stale fee, and it's just something that hasn't been revisited in a while. And when it's brought to them, it's an easy fix much of the time, but it's just kind of not top of mind. It's back-burnered stuff, and as I said earlier, sometimes the managers are just as surprised and happy to make the client whole. It's not something nefarious all the time, but there are errors, and that's the lowest hanging fruit that we're able to find.
Exactly. I think slide 9, should give you an idea about all of the cost elements that we look at in the public markets, and I will not go through all of the details. I think that's something that you can take a look, at later stage. But I think what's really important for us is we're a data-driven organization. We love data. We love what we do actually, and it's like we want to have a fair it's like benchmarking and it's like negotiation. It's not just like a position bargaining approach. It's like if we identify it's like that there is a manager that everything works perfect. It's like we have the finding, everything works perfect. Yeah. And we do have, it's like very often nothing to add really. And that there are some organizations that I can, maybe shed some light at a later stage. It's like where we have a feeling that there is a true, it's like there's a true belief, it's like making everything as efficient as possible. But at the same time, I can tell you that, some sorts, it's like some trends in the industry, especially in outsourced trading or FX middle office outsourcing from some asset manager groups, they tend to essentially bring profit and loss elements, it's like from the asset manager organization down to the client portfolios. Yeah, so essentially that your account is paying a certain amount, it's like research dollars or FX, outsourcing fees with your NAV. And I think something that we need to watch out, where we need to bring, it's like clear transparency to the market and measure the inefficiency in what we see. Those things on slide 9 should give you an idea of what we're looking at in the public markets and how deep we are, and how far we go.
And the way we connect the dots, right? So you have a manager that has high turnover, and they also have high trading costs, and they also, what does that mean when you think about settlement charges at the bank? What does it mean about when you think about the FX trade on the back end? All of these data points on all of these things on this page go into that total cost of ownership. And then when you see it all together, it's like, wow, we could make this a lot more efficient. Maybe we should rethink with this top line fee, or maybe there are changes in the process, introducing new trading partners on the FX side. Maybe it's how it's handled at the bank. So it's really thinking about all of these costs and processes holistically in a way that no other firm out there is doing that. And I think, certainly Wilshire is in a unique position to affirm that, given the due diligence they did before before acquiring us. So it's just a really, really unique value proposition and really granular work that we're doing.
So far, any question of the group?
Mark, Ian, I've got 3 or 4. I'm not sure exactly what order you want to take them in, but just to kind of put an example, that we can relate to. Can you give us, roughly what you're looking at as far as, your average client, the success rate, what kind of costs you've been able to save?
Yeah, that's the most important question actually for clients, and it's like there's no easy answer. There's not one number, George, that we can point out. It's dependent on the amount of it's like of money being managed active versus passive. I think that's one of the key drivers. It's it's geared towards it's like if we do have a lot of private markets where we have less findings but larger, it's like more major impact findings. Yeah. It's not easy to say. I can tell you though that our business model would not work if we would not find significant optimization potential in our client mandates. Now, we usually work for asset owners, it's like above 2 billion. It's like you're currently at the sweet spot is like between 10 and 20 billion. I think that's a sweet spot, but we also have clients, it's like it's like more than 50, 75 billion, it's like, and that's potentially insurance related money.
Of your
So it's in a
$20 billion clients, what are we looking at numbers wise?
Excuse me, can you repeat that?
Said of your $20 billion clients, what kind of numbers are we looking at?
I will give you a range
That's
to get a better feeling, and it's like it will be something around if it's it's like the usual international portfolios active managers, it will be around 1 to 8 basis points.
Okay.
And just like we do have
And
it's
Mark,
like
I'm sorry, Mark, and that would be based on the total. So Lyle asked a question about a $20 billion portfolio. You mean as applied to that asset base, right?
exact. Yeah. And it's like there are all the findings going in. It's like even if we have a trade-based finding, yeah, it will be essentially then, it's like if we save $200,000, it's like on brokerage for US equities, I think you can, account that, it's like based on the asset under management level. It's like it's a significant amount of money. It's like we haven't looked at essentially the information about it's like the fees that are being paid, the manager names that you're engaged with, and it's like have come up with a so some sort broader or more closer thing. But in general, I think it wouldn't be worthwhile to look at, it's like saving potentially below 1 basis point. But there are organizations, it's like that are, heavily geared towards passive management, where it's like it's impossible to essentially save 1 basis points. Yeah, we are not magicians. It's like we can't save you in U.S. Treasuries if there is a buy and hold or buy and maintain strategy. It's not that we can save you there. But it's like if we see more and more trading, especially in international, if we have more FX, if we have more hedging, if we have more activity in the portfolio, more private markets, those optimizations tends to be larger. As a rule of thumb, George.
And while we don't find something for every manager that's actionable and will move the needle at the full fund level, we're very confident that there would be some compelling avenues to pursue. And some of the data that you'll find will come back to you and you'll say, maybe we don't want to pursue this optimization, but it's still very, very important to know, when you're thinking about future investments, who your partners are. It'll make you, smarter when you're, wiser when you're negotiating new terms on a new investment. So there's an implicit value as well. I think that we bring to the table.
Well, that kind of leads me to my second question. That's if you uncover issues where we're paying, what we assume are exorbitant fees internally. what leverage do we have as far as getting those fees down if we already have a contract?
It's my daily business to negotiate contracts down. There's no, it's not essentially, it's like it's not that fixed. Let's put it this way.
Yeah, and that was my biggest question when I was joining XTP. I said, well, if a contract's a contract, how do you have room to negotiate? But believe it or not, you know, it's a collaborative process, and the renegotiating the terms is a mechanism that these managers are happy to when they see the data and they see how we recontextualize that total cost of ownership, you'd be surprised how they're open to, say, adding a new tier in the fee structure, or if they're not willing to, say, maybe cap soft dollars or change their process on the trading, the fee structure is a mechanism that is often the easiest path forward, and they're much more inclined to revisit those terms than you might think.
I think, Mark, when you go through an example or two in here, I think Lyle and everyone else, that'll become clear, because some of these things
Mhm.
aren't even about the terms, but
Exactly.
are about how those terms are being applied and managed. So I think the examples will be helpful for that.
And maybe we can go to slide 13 to give you a better, it's like we don't have case studies today for within this deck, but if we can go to slide 13 from this one on, yeah, 4 slides down. I think that's it's like some examples that we've brought with us. It's like example findings, and and you will see that it's like for a lot of the bullet points that we will go through today, there is not even a signed contract. Yeah, because it's like in the area, especially of the asset managers, to essentially negotiate and agree on fees on their self. Yeah. And so, it's like one of the bread and butter, it's like findings that we have is essentially too high implicit transaction costs in trading stocks, bonds, and FX. And we do have, it's like built certain algorithms, it's like to identify optimization potential and then help to bring down those costs. If those costs are not essentially embedded as a function of the manager's decision, aka outsourcing FX to a bank because they did not want to essentially employ an FX trader anymore. Yeah. And the second bullet, wrong broker panel, is something that we found more and more often, in an ever-changing environment in the financial industry. And with some, it's like smaller managers or medium-sized managers are reluctant to change the broker panel. It's like to always having the most, up-to-date list and, very strong broker names. We do find broker panels being, less efficient than they could. Yeah. And it's like due to the nature of our business that we do see, it's like from 1,000 asset managers, it's like trading in, it's like in securities, but in equities and bonds and FX and all of the other derivatives. It's like we know it's like which bank and which broker is really good at trading what currently, and can bring some suggestions to it's like the trading desk of the managers, and that's it's like what Ian and David meant. It's like we have a very collaborative approach with a few managers because they actually love what we do. It's like we help them to bring their internal costs down, and then we are it's like perfectly in line, and it's a win-win situation. But there are cost elements where we are not potentially that aligned with. Yeah. We've brought up the example of, uncompetitive run rates and commingled funds. That's an area that's very important to look at. It's like we often identify uncompetitive management fees and performance fees. That's the area where we have to sign contract. Yeah, that's the one area. Yeah. One of the other areas, usually we don't have to sign contract as a client on a client level. We do find, it's like not often, but occasionally we find that MFN clauses are not adhered to. Yeah, it's shocking to me sometimes, how managers have, set up certain, language in the contracts that they do not need to apply MFNs, for certain client groups. And having done that in the US now for roughly 9, 10-ish years, that's an area where you should definitely look at, and that's it's like where we have it's like a lot of interesting findings. But on other elements, like in the private, we haven't touched the private markets currently, but it's like the overuse of subscription line of credit, for example. It's like it's an implicit slippage in your performance that it's like you usually not find, and it's like where no invoice is being issued to you or to the commingled vehicle that you're invested in. It's just a slippage that goes with and that you really can't see in the NAV performance. Also, the last point, for example, tech leaches, we are not a tax consultant. However, we do find very often with groups like yours that have a certain tax status, investments in fund wrappers or in strategies that are not tax efficient, and where we can save the group to essentially get higher withholding tax recoveries, or have a different investment structure being implemented to have a higher net return without changing the risk profile of the strategy. Yeah, to give you an idea about certain elements, yeah, I have to say, from the 50 people, we wouldn't need, like that much people if we would just do the management fee piece. I have to tell you, because like then it seems like an easy benchmarking. Yeah, where we really specialize, and it's like from the 180 cost elements that we look at, it's like one is management fee and one is performance fee or carry or name it whatever you like. But all of the other elements, it's like 170 plus. It's typically elements where you do not see any invoice, but essentially are being paid within the prices of it's like the securities that you buy or sell, or the FXs that you buy or sell, or directly as a pass-through expenses in your custody account, or any other thing that could be booked into your accounts. And that's where we specialize as a group and as an organization. And that's why, George, it makes so hard is like to do is like precise estimation on essentially the findings and the savings potential, because it's unknown also for us. It is like at a starting point, what we will potentially uncover in a project, if that makes sense.
And also and just to reiterate, we don't just deliver a report to you and say, here's what we found, see what you can do. Our whole value propositions really begins after that we deliver that report, and let's lead those conversations on your behalf, and see if we can generate any savings. And again, it's collaborative. It's not a combative exercise. Our approach would not work if we were picking fights with managers. It's not like that.
Exactly.
It's very collaborative. It's just in the interest of transparency. Let's uncover what's really happening underneath the hood, and let's see what we can do to make it more efficient.
Go back.
George, do you have
Yeah.
other
Go back.
questions?
Yeah, just a couple. I don't want to get ahead of the presentation, and I'm not sure what they're going to get into or not, but just to confirm that basis point number you gave me earlier. Did you say between 4 and 8 basis points?
1 and 8.
Okay. I punch numbers, because that's what I do. At 2 basis points based on a $20 billion portfolio, you're looking at approximately $4 million in savings, right?
Yeah.
Yeah.
It's not something that we can guarantee you, and it's not something. Yeah, that's.
I'm just want to have some idea that what kind of number we're talking about. That we're not talking about $200,000. We're talking about something significant.
Yeah,
that's number one. And I don't know, in your presentation, you're going to touch on how you all get paid. If you are, then I'll save those questions at this point.
I think, it could make sense to, like get directly into, because it's like slide 13 is the last one, and we would then go back. Yeah.
Mark, maybe I could
Yeah.
take 1 second
Yes,
before
please.
we do that, just to help even in Lyle's question in that example you just gave. Mark keeps mentioning that they're collaborative with managers in this process. So it's really, I think, really important to understand that issue and how that plays out, because as they said, the value proposition is after the report. Once they have the findings, they go through the findings with you, and it's entirely up to you what you want them to pursue or not pursue. So I think even part of that, Mark, tell me if I'm wrong, even part of that you're not able to guarantee things. XYZ manager, if you are to tell them, we don't want you to call them, we don't want to pursue this for whatever reason, they don't. So it is literally that collaborative, and that they're not doing anything with managers that you're not aware of, because those are your
Yeah.
managers.
And I think also what's important to keep in mind is that it's like full partners. What that means is like if we're optimizing a manager and it's like because of it's like a change in asset allocation, for example, like this manager is not in your portfolio after 2 months of the implementation, we will have no participation on any savings because you have not received savings. And it's like we've built, as entrepreneur, we've built it around it's like bringing, it's like the asset owner and our, it's like that we have no conflict of interest, that we are fully 100% aligned. Only if you save something, it's like we get paid, it's like a percentage of that savings. And we do not want to, it's like bring up, it's like a great number of savings potential, but then we are not able to implement anything because it was, it's like too aggressive potentially. And it's like we're working on something and, bill you then any, hours on top of that. It's like that's not the business model. Ian?
Yeah, and I would just say, we only get paid when we're able to move the needle. So if we're able to negotiate a new fee, or or we find an error in the process, in the invoicing, or along the value chain, from the correction on is when we get paid. So when that money, that savings is realized by CERS, then we will invoice you after that.
And I've just looked up something. I think that's important to understand how it's like the basis point number works. It's like in a client setup that it's like is very similar to yours. It's like we have not one optimization that has like that amount of basis point impact, but we had it's like 43 smaller optimizations with different managers. Yeah. And it's like with more than 60% of the managers, we weren't able to receive any optimization for the client because it worked like a charm. Everything was perfect. Yeah. But then there was one or two big elements. Yeah. That's usually how essentially it adds up to that big number. And, it's not that we find currently, it's like on one thing, on one area where we have the most optimization potential. We can't tell you from the beginning because every organization, it's like in every organization and every setup is a bit different. But it's like my remarks too is like if you have more hedge funds, if you have more private markets, if you have more international equities, if you have more, it's like hedging derivatives, that's, it's like everything that has cost, it's like the percentage chance is like that we find something there is higher. Yeah. But, I can tell you that there are some managers, even if you're paying them 220 or even 330 nowadays in the hedge fund world, it's like we will get actually zero. And I would not recommend, it's like to spend any minute on one or the other names in the industry because it's not worth it. Yeah. You can do the recalculation, but there's no renegotiation. And, it's like you need to know those groups. You need to know and understand essentially, it's like who's open for certain optimizations and negotiations and who's not open at all.
Right. And we don't want to spin our wheels either, right?
Yeah.
So we want to be smart about the way we look at things. If you know a manager is going to be fired next quarter, that's probably not something that we want to spend our time working on either. So, but to the extent that we can work as an extension of your staff, leverage this data that we have, and then have these conversations on your partner's behalf, on the managers, on your behalf with your managers, I should say. There's a lot of value, and the whole firm is sustained on fat on the bone. So, there's a lot of waste out there. There's a lot of inefficiencies. It's not necessarily nefarious, but when you have a quantitative means of approaching it, there's savings to be had. And the firm's been around for 20 years before our collaboration with Wilshire. There's 50 plus employees that are all compensated just on this fat on the bone. So they're from a proof of concept standpoint. I'm 2 years into it. I've seen these conversations that happen, and it's really, really unique. And again, coming from my position, perspective at Able Noser, where I thought we were having really thoughtful conversations with managers about how their investments were being implemented. this is really next level, next generation oversight and due diligence, and it's project based. So, you know, we're not going to just deliver these reports indefinitely to you. We're going to deliver it to you. We're going to bring it to a conclusion, and we're going to either find a path forward or not. But, you know, you'll know what those costs are, what the impact of those costs and processes are, and it'll make you a better investor, I believe.
Well, certainly helps to fulfill our fiduciary responsibility for sure. As you have pointed out several times, unless you find savings, you don't get paid. You want to cover what your split is on the savings?
Do you want to touch that now, Mark, or me?
Yeah, please go ahead.
So we share for 2 years to the tune of 50% of the savings. And the reason it's 50%, candidly, is because in our experience, there will be optimization opportunities that you won't want to pursue. And that's completely your prerogative. You know, as David said, you're always in the driver's seat, but there is a lot of big, heavy lifting that goes into this analysis. This is not a check the box exercise. It's very granular, particularly on the private market side, which we haven't touched on yet, but the private markets especially is a really heavy lift. So there will be opportunities you probably don't want to pursue, and that's okay. But when we do have a win, we need to participate to the tune of 50% for 2 years, and then we're out of it. And then the savings is 100% yours from that point on.
Okay.
Any other questions, George?
I don't think so. I think you covered what my questions are. You know, I certainly appreciate their business model from the standpoint that, you know, they don't win unless we win. So I've got no problem with that. I think we've got some issues or questions we need to figure out on the procurement end and that sort of thing, Bill. But I think just from what I'm hearing anyway, I'm certainly in favor of it because I fully understand where some of these fees and costs can be hidden that we don't see. And I think based on our past history, we've determined that as well. You know, going forward, I can't help but think this certainly strengthens our fiduciary responsibility, number one, and lowers our legal exposure, number two. But you know, from that standpoint, and you know, from the strategic plan that we're putting together, I think Betty addresses some of the issues that you had in item D, as far as ensuring both financial and economic risk management. So anyway, I'd certainly be in favor of pursuing, you know, whether it's with these folks or somebody else that may be out there, but continue to look down this path.
Anyone else on the committee have questions? How about staff? Steve, Ed, Ryan, you all have any questions?
I think it's this is kind of a natural extension of the old TCA and if efficiencies that can be gained, and I'm all for the more data the better. Curious the breakdown generally between where you find savings on the public market side mandates versus private market side mandate, just kind of a breakdown.
The percentage on a client on a client level.
Yeah, just overall across your book of business, how much of the savings is found in public market mandates versus private market mandates?
Given the book of our businesses, I think geared, like heavily towards the public markets. It's like the amount of, it's like optimizations that we find, but there are some significant and major findings in private markets for larger clients like yours. Yeah. So for like smaller client groups, it's like we have, it's like also, it's like 2 billion clients that have, 300 million private markets where essentially the lots are very small. It's potentially, it's like not really worth investigating. So it's zero then. Yeah. And it's like still worth investigating on the public market side. So does that make sense?
Yes, thank you.
And it's like if you look at private and public, it's like given the case that it's like more and more manager groups will it's like acquire it's like if coming from public it's like private companies or private asset managers, that means that it's like if you look at the relationship of your of the client with a manager group like like the likes of Prudential that have it's like public markets as well as private markets. I think it makes sense to look at that holistically and from public and private market at the same time, because then you get the full breadth of the relationship and potentially bring the needle or move the needle a little bit more easier.
Mr. Chair, thank you for asking. I don't have any questions, but I did want to reiterate just a couple of points that Lyle made. I do believe that from a fiduciary responsibility standpoint, this is an excellent exercise for the committee and the board to pursue. And also from a risk management standpoint, I think it gives a complete cover on understanding that processes and contracts are being executed as they are written.
Yeah, so that's the question that I had, because there's two approaches. There's some that we would have existing contracts that there would be terms that would be negotiated or changed, versus the failure to apply those that you would say you had said errors, et cetera. Give me a feel for the mix between the two. How many of these items do you usually see that it's existing contract that you're going to go and attempt to renegotiate versus just an error or something that didn't get in there correctly from what we have?
Yeah. So on the private side, it's geared towards errors and essentially not the right application of waterfall language. It's like in the calculations. And it's like in public, it's more geared towards essentially negotiating better rates. And as I said, it's like the vast majority of it's like findings are in the where we would not negotiate a new contract, but where it's like hidden costs within it's like the asset management mandate. Yeah, but it's like public markets more. It's like positively speaking, it's like optimizations, for the future, and it's like on private, our findings are more geared towards it's like making the world right, yeah, and doing the recalculation it.
And some of the things, it's an exercise in governance on the private side, and some of the things we find are step down dates not being adhered to. We find, we recalculate from the bottom up. We find how they're using their Slack programs to get to the waterfall calculations faster. They're opaque by design, these vehicles, right? So our team studies these LPAs and the side letters and recalculates accordingly. And it's kind of like the Wild West right now, right? And in the private market space. So to have somebody and a team of people that are really getting into the weeds on the language and it's just bandwidth constraints would always keep you from this kind of level of detail.
Thank you.
All right, any other questions? What would be the appropriate next steps, committee, do you think is appropriate at this time?
I would think at this point, the first thing is determine what the procurement issues that we may or may not have. And then depending on those answers, Bill, either bring it back to finance or take it straight to the full board for consideration, depending on what those answers are.
It seems to me that it's more of an investment issue than a finance issue. I would expect that the investment committee should look at this, and I mean we've discussed it already, but it would seem that the recommendation ought to come from the investment committee.
I agree with Betty. It does seem to be more of an investment issue than finance.
Well, investment committee referred it to us, so I don't want to get into a ping pong here internally.
Mr. Omer, this is Victoria Hale. I just
Yes.
wanted to raise an issue as well, that all the contracts currently, C does not have separate contracts under their own name. So that is another thing that the committee or board may want to look at, is that all the contracts currently are under the KRS name.
Well, that is another level that I had not thought of.
Like I said, I think, Bill, at this point, we just need to pursue finding out how we need to go about this and then determine a path forward at that point, whether it goes back through either one of the two committees or straight to the board. You know, we, like I said, depends on the answers to those questions.
Well, you could avoid the ping pong issue if you just went directly to the board.
I agree. But like I said, I think that's going to be dependent on some of those answers that Victoria brought up, which, you know, that issue itself is a whole nother issue that needs to be reviewed as well, but we'll figure that one out in time.
Well, what I'm hearing is that the committee's will is to investigate certain aspects of this type of contract, doing our due diligence, and then deciding whether to recommend it to the full board.
Bill, I think Jerry's got his hand up.
I'm sorry, I can't see. Please tell me.
No.
Yes, Jerry.
All right. Yeah, didn't know you couldn't see. I think the first, probably the most driving thing that needs to be done is how to proceed with it through procurement. And then we could maybe, then once we find out that, then we can figure out even perhaps which committee or whether take it directly to the board, what we need to do first, just how this would fit in the procurement model.
All right. Well, would it be the committee's wish that I would pursue those questions with our procurement and legal eagles along with XTP so that we could flesh those questions out?
Certainly want to be transparent on the process. I think that's the smartest way to move forward.
Yes, and we are working on that. We were having discussion this morning, so that is actively being worked on.
Great.
All right. Great, thank you.
All right. Well, Ian, David, and Mark, we certainly appreciate very informative and very intriguing presentation. And we'll be getting back with all of you.
Thank you very much.
So much.
It was a
Thank
pleasure
you very
being with
much.
you. Thank you very much. Any questions, please don't hesitate.
All right. Thanks so much.
Yep.
Thank
Have
you,
a
guys.
great day. Thanks.
Thank you.
Take
Bye.
care.
Bye.
All right. Next on the agenda is Mike Lamb and quarterly financial reports. Mike, take it away.
Thank you, Mr. O'Mara. Welcome, everyone. Sherry, I'm going to start on page 20 and near the bottom, you'll see that fiduciary net position for the C system is $19.1 billion, which is up 8.3% or $1.5 billion year over year. The two pension plans total $13.6 billion. That's 10 billion and 3.6 billion, and increased 9.6% over the year, or in comparing year to year. The two insurance plans total 5.5 billion, and they increased 6.98% or 356 million. If you scroll up just a little bit, you can see that the total investments at fair value increased 8.4% or 1.4 billion when comparing the first 6 months of this year to the first 6 months of last year. The pension plans are up 9% by themselves. The insurance plans are up 6.76%. The largest increase in this asset value is the core fixed income. So it's showing 39.99% or 697 million across all the plans. That's followed by real return 39.69% or 264 million, and specialty credit is also up 12.49% or 431 million when comparing their balances. So the public equities only had a slight increase, and in discussing this a little bit with my team, A lot of this increase in the core fixed income is this asset reallocation and the additional contributions being put into core fixed income versus public equity. So public equity made quite a bit of money in the first 6 months, but a lot of that money's been reallocated to core fixed income. So the balance in core fixed income is quite a bit higher. Not that it performed that well, although it did perform. A lot of the performance in public equities was reallocated. I do want to go down to the combining statement of changes in net position. I'm going to start on page 23, which is the bottom page. And just below the deductions line, you can see the net increase, decrease in fiduciary net position. The total for 2025 is 590 million. So that's the change in our net position for the first 6 months. Last year, that change was 775 million for the first 6 months. The two pension plans show 305 million and 147 million, and the two insurance plans show 104 million and 34 million. This year's increase, again, is driven by the net appreciation in the fair value investments of a 604 million. So you're going to have to scroll back up to the page before this. Perfect. So 604 million is the net appreciation in fair value of investments. That's 10.88% higher than it was in the last year. And as I mentioned before, a lot of that is due to the public equity gains and then the gains in other asset classes as well, including fixed income, real return, and specialty credit. Some of the reasons for this overall increase besides the fair value fair value of investments can be explained a little bit on the contribution pages starting on page 24. So looking at pension right here, through Q2, the pensions plans received $581 million in total contributions. So that's the 78.4 million, the 316.7 million, and the 33 million and the 152.5 million, both the hazardous and non-hazardous plans. When comparing that to prior year contributions were 621 million. So this year we're $41 million less in compared to those first 6 months. Member contributions are up 6 million, while employer contributions are down 46.5 million. The total payroll for the CERS plans through December 31 is up 136 million, or 7.17%. There's over 1,500 more active members that first 6 months compared to the first 2 quarters of the prior year. However, the employer rates for CERS non-hazardous have decreased from 23.34 to 19.71. And for CERS hazardous, they went down from 41.11 to 36.49. That's resulting in lower employer contributions in comparing period to period. The net investment income, interest plus dividends less investment expenses, performance fees, and carried interest for the two pension plans was 153.9 million, which is this 112.9 under hazardous and the 41.0 under the 112.9 under non-hazardous, 41 million under hazardous, and that is 15 million or 10.72% higher than the first 2 quarters of the prior year. Both of the plans paid out 718.3 million in benefits, refunds, and admin expenses versus 656.9 million last year, and that's $61.4 million more, or 9.35% higher. All of that shows that in this light yellow net contributions, the CERS non-hazardous pension plan has a negative net contribution of 17 million. The CERS hazardous plan has a positive contribution of 33.2 million. However, if we remove the net investment income and come down here to this cash flow statement, you can see that C non-hazardous is negative 129.9 and the C hazardous plan is negative 7.8 million. And that's through the first 2 quarters. Scroll up a little bit and we could talk about the insurance plans. I'm going to start with the highlighted net contributions. So the C non-hazardous insurance plans minus 9.6 million or 9.5 million. The hazardous is 20.8 million negative in cash flow. If we remove the net investment income of 41.5 million and 18.9 million, The bottom chart shows minus 51 million and minus 39.7 million, respectively. The cash flow from the contributions and member employer is less, and also, the employer contributions have gone down because of the interest rate, or the employer rates being 0 for non-hazardous and lower for hazardous. And we did not receive Humana gain share in the first 6 months of 2025, where we received 10.4 million in 24 and 1.6 million in the hazardous plan. That is the financials and contribution statements. I'm going to pause there if you would like to discuss questions before I move on to the other invoice and admin budget.
Ms. Pendergrass has her hand raised.
When PPOB asked for this analysis that takes the net investment income out of cash flow and calculates these additional percentages, did they provide, this might be a question more for Rebecca, did PPOB provide any benchmarks for what kind of percentages they were looking for on these two categories? Did they explain why they are not including gains and losses in the investment portfolio in this analysis?
To the best of my memory, they did not give us any kind of benchmarking. I think what they were looking for was a more consistent way to compare across plans. So not only CERS and KERS and state police, but also teachers and judicial forum. So I think they gave us the formulas and said, do it this way so that they would get some uniformity across all of the Commonwealth's plans. But other than that, I don't remember any kind of benchmarking. But if you need more information, we can do something with that.
No, I wouldn't chase that rabbit too far. I think there are some benchmarks out there that indicate cash flow. When negative cash flow is a very bad thing, and when it's not quite so bad. I've heard teachers talk about some benchmarks from peer groups. So what might be more relevant is looking for accurate benchmarks that give us some ideas of performance indicators that would be worth us tracking for our system, as well as comparing it to peer statewide managed plans. If we could get a peer group of statewide managed plans compiled so that we had similar plans that we could use for comparison.
I think that makes sense. The actuaries, depending on which actuary you ask, has those, and I've heard them anywhere from 2% to 6%. It's usually 2 to 4 or 3 to 5 or something like that, depending on your actuary. But
well, then, and it would also depend on the maturity of your system. We have a unique situation because tier 1 and tier 2 are going to phase out, and tier 3 is going to phase in. And looking at how each one of the tiers is performing, I think makes some sense. Tier 1 and tier 2 are going to use up assets at a larger rate than tier 3 is. And as those two tiers fade out, theoretically, we should use all the tier 1, tier 2 assets to pay off those benefits at some point in time.
Betty, I said in listening to those meetings that you're talking about with PPOB, I think it's probably made me feel better, even though they wanted to, point out to us what ours was. But Rebecca, Ed, you probably can chime in on the numbers, but if I remember correctly, our negative cash flow was significantly less than the other systems statewide.
Yes, that's correct. But there were some legislators that believe any negative is a horrible thing. So I that's why I'm.
Yeah, I think that's an education thing on our part that we need to address.
It's been tried. So that's
Yeah.
why I lean toward evaluating our own system. We can provide PPOB what they want, and what they do with it is up to them. I think it's more productive for us to go look for benchmarks and analyze our tiers with their unique characteristics to try to evaluate how our system is doing compared with some similar statewide managed plans across the country.
If I could, Mr. Chairman, as I remember this conversation at PPOB, it was talked about in conjunction with another Kentucky plan that was right at 3% of assets, negative cash flow. And it was determined or stated by their actuary that anywhere from 1 to 3% negative cash flow as a percentage of assets represented a healthy plan. So if you look even today, as our percent of our negative cash flow as a percent of assets has gone up, it's still less than 1.5%, which would be half of what another system was dealing with when they were presenting to PPOB.
Bill, I've just got one other question for Mike.
Please go ahead.
Well, it's page 20, actually page 21, Mike. Your first note. Trying to flip to it. There we go. The variance talking about cash flow running through the Chase bank accounts. Yeah, I've seen that note for quite some time now. Are we getting close to figuring that one out?
Yeah, Sherry, if you scroll up just a little bit so I could show that cash balance, it's the first line of the pages. So, right now we have $441,000 in all four of the C plans, right? So there's 284 in the non-hazardous. Last year there's 4.8 million. So effective March 2024 is when I completed my analysis of what's been running through the Chase accounts and what potential we may have of overdrawing those accounts if we don't leave enough in there, et cetera, et cetera. So I came up with some standards that my team is now using to adjust the bank balances at least quarterly so I think the C hazards is supposed to be $250,000. The other ones are much smaller than that, even down to $25,000. So every quarter they will move any excess money in JP Morgan up to the Bank of New York Mellon to bring that. So I think next quarter we will see a pretty even comparison from 25 to 24 when we look at the balance in the cash accounts at JP Morgan.
Thanks.
Go ahead, Mike.
Okay, so moving down to, I believe we're on page 25. So this is showing the outstanding invoices by type and employer. The grand total at December 31 is almost $2.3 million compared to $3.3 million at the end of September. So we've decreased 31%, which is great. ERC and legal continue to work past due invoices with various employers, and they've made lots of collections between September and December. And then the top 10 employers are listed there. The stars, again, are items that have been referred to legal and being worked on by legal. So your biggest employer has been there for several years now. It's Kentucky River Regional Jail. Legal is working on some things with them, as well as City of Cummington and Fort Thomas and Taylor Mill, as well as Jeffersontown. So those top, 4 there or 5 are working. Some of you are familiar with Elliott Ambulance. There's 100,000 there, and then it starts to get significantly lower in past due balances to some of these smaller entities in the top 10 now. So that's looking great compared to what it has been over the last year or so. The next page shows the number of penalty invoices that were issued during the quarter, so 20, totaling $20,000. And the next page is the number of penalty invoices. Well, the first page was 20 that were waived for various reasons. The next page shows 13 were created during the quarter. And then the last few pages, there's a lot. We actually had 115 penalty invoices that were paid. And again, this is the efforts of the ERSI group, working with employers, sending out notices for their penalty invoices and doing what they can to collect them. So we collected $115,000 in penalty invoices that were outstanding during the last 3 months. So I want to commend the ERSI group for continuing to do that. And then now I think we get down to the admin budget. So I've put the notes in there. Again, at this summary level, I'm not going to read them through that. But what I do want to point out is in the personnel line item, we did include $1 million for 9 additional positions that we sought approval to increase our cap for through the budget office. The budget office has actually approved those positions, so they are, available to us to begin to meet the needs of the agency by filling those. Although we haven't filled them, it's now February, so we should still come under budget by about $1 million at the end of the year in the personnel line item. The legal contracts, as you can see, is running a little bit close to budget. There's been significant legal fees going on. If you look, I'm not going to have Sherry go down there right now, but if you look in the detail of the admin budget, you'll see certain line items for certain attorneys are higher than their budget. Some are lower than their budget. So overall, we should still come in line with being under budget for the admin costs related to legal expenses. The bottom line there is the operational total. We spent $2.6 million in the operations category, leaving 62.48% for the next 2 quarters. There's some individual line items that move up and down, nothing that concerns me. And so totally at the end of the 6 months, we are 4.13% higher than we were last year, and we still have 55.41% left to spend in the remaining half of the fiscal year. There are individual line items as Sherry wants to scroll down. If anyone has a question on those, I would be happy to address them.
There's a significant difference in the audit expenses from 25 to 24. Does the 98 include everything we're going to pay for the audit that was just completed?
I don't believe it has the January billing that Blue and Company sent to us, and Blue and Company is still finalizing our GASB 68 and 75 reports and the audit associated with those. So we're going to have some additional billings in them. I do not think we'll hit near the $300,000 that was budgeted, but probably close to 200,000 would be my guess for the fiscal year.
We do have a timing difference between 25 and 24.
Yes.
Okay, thanks.
Any other questions on the admin budget? Mike, do you have anything else to add?
The bottom charts at the bottom again were they're the JP Morgan fees and how these admin costs have been allocated to the various systems for the first 6 months. And that's it.
Scroll. Is it the next page?
This is JP interest that's been earned on those accounts. The chart right above that is and then there should be a hybrid allocation. I don't know if it's right below
It's the bottom of page 34 is the allocation.
Ah, perfect.
There we go. All right. Any other questions for Mike Lamb? Thank you, Mike. We appreciate you and your staff's diligence and hard work on this.
Thanks.
All right, we'll move to hazardous duty request, Mr. Surratt.
Good afternoon. Today we have 9 positions being requested for hazardous duty coverage. All the positions are police, fire, and there is 1 paramedic position. The education officer position listed, that is a paramedic position. However, in addition to the paramedic duties, they also are responsible for overseeing all initial certification courses and provide training programs to the Madison County EMS personnel. So that's why the name of the title is education officer. But KPPA staff has reviewed the position questionnaires and job descriptions for all these positions, and they do meet the statutory guidelines for hazardous duty. If anyone has any questions, I'm happy to answer them. If not, I would like to request the CRS Finance Committee approve these to go forth in front of the CRS Board of Trustees for final approval.
Do I have any questions?
So move for approval.
I have a motion to approve. Do I have a second?
Second.
Moved, approve, and second. All in favor, please say aye.
Uh,
All opposed? The ayes have it.
I did have one technical request. I wanted to look at one particular item, and because we have so many pages for this particular packet, it was a little difficult to find it. If we could put the packet page number, not the board book page number, because that page number will vary depending on other stuff in the board book packet for any particular meeting. But if the staff could give us a page number to in the appendix where we can go find a particular position if we want to look at the information for that one, it might make it easier for us to navigate among a tall stack of stuff.
But I can get with Sherry to work on that for you.
Thanks.
All right, any other questions? All right, thank you. Moving on to Mr. Willer and investment budget.
Thank you. Next page, please, Sherry. So that's a tough act to follow from a brevity standpoint, but I will certainly try to keep my comments as brief as possible. Just want to provide the brief quarterly update on the investment budget. And through the first half of the fiscal year 2025, actual expenses were running in line with the amount budgeted, with a total of $6 million or 48% of the budget spent year to date. Echoing some of Mike's comments, during the quarter, we saw a large uptick in overall legal expenses as activity increased for a number of ongoing cases. And as we have continued to see elevated legal activity as cases move through the legal process, we expect legal expenses will remain high. So we may see some volatility in that bottom line number as they remain high for the remainder of the fiscal year. I'll pause on that budget and ask if there's any questions. There were no line items that are concerning to us. I think everything is in line with budget, in line with forecast, and where we expect it to be at this point in the fiscal year. If not, Sherry, you can move to page 41, please. Thank you. Through the first 2 quarters of the fiscal year, investment fees and expenses across the pension and insurance trust were $31.1 million, or 32% more than for the same period last year, while total assets have increased 11%. For the period, the base investment advisory fees, so those are the base fees that we pay to external managers, increased $5.9 million, or 15%. The most significant drivers of the increase in overall fees and expenses were the rise in the expense category, which includes lines of credit, which increased by $6.7 million, and the increase in performance fees, which have risen $15.6 million, fairly evenly spread across specialty credit, real estate, real return, and private equity. I would also note that the $3 million increase in administrative expense line item is largely attributable to that increase in legal fees that we saw on the prior budget. Focusing just on the investment advisory fees, which are typically the most controllable for us, and those are the base fees that the systems pay to those external managers. I would note the consistency across time with a 25% increase in fees since 2021, which is commensurate with the 35% increase in total assets over the same period. As we've done before, I would also highlight the reduction in core fixed income advisory fees, which have increased just 3% year on year, while assets in that category have increased 39%. And fixed income fees are also lower than they were for the same period in 2023, despite a 56% increase in total assets. I would also note on this report, at the request of Ms. Pendergrass at the last meeting, we included a category here. As you can see, it's called annualized fee rate. Apologies for the very small text, but it was hard to fit in there. And that's an estimate of the annualized fee fund rate for each asset class, both at the overall fee level, which includes performance fees and expenses, as well as just for the base investment advisory fee. And I would caution, as we talked about at the last meeting, that this is a pretty simplistic approximation of the fees paid for the first 2 quarters that are then annualized, as market values and rebalancing of market activity will impact the actual fees. So this is just an approximation of the running fee rate on an annualized basis for each asset class.
Thanks. It is helpful to have that information. I appreciate you adding it into the table.
Absolutely. And I'll pause there for any questions. I will say that additionally, Mr. Cheatham highlighted last time, there will be differences. Sherry, if you move forward 2 pages. I didn't include on this page. Yeah, that's perfect. So those numbers on the prior page are reported at the total trust level, the total pension trust and the total investment trust level. If you did the calculations here based purely on CERS and CERS hazardous pension and insurance, you'll notice modest differences between what that simplistic calculation of a running fee rate. I would note that for real estate, the CERS, you'd calculate 81 basis points for advisory fees versus what we showed as 77 for the total pension. That really just has to do with the allocation, the underlying allocation amongst the building block mandates that make up that entire real estate allocation. So you'll notice slight differences based on allocations. And I think the largest I noted was in the real return allocation, where the total pension shows a 50 basis point investment advisory fee annual rate, whereas the CERS has 64 basis points.
Go ahead, Steve.
Happy to take any additional questions.
Hearing none. What do you have else for us?
That's all I have on the investment budget.
All right. Next is Finance Committee Strategic Plan. And I'd like to ask Ms. Pendergrass to walk us through this, please.
Sure. What I've put in the packet, Sherry, if you'll go to page 56 of board books, please, ma'am. What I've put in board books is the entire draft of the board's strategic plan, so that finance committee members could see what other committees have done with their goals, their objectives, measures, and targets, to kind of give us an idea of how we could polish off the finance goals in goal number 3. Essentially, a measure is an indicator, a benchmark, if you will, of when you look at a particular issue, what are you looking to give you a sense that we are making progress toward the objective that's outlined at the beginning of each one of those boxes. The target can be a specific number, or it can be a range of numbers. We had some ranges in the investment measures and targets for where we wanted certain indicators to be. So what I've done with this particular proposal is I've taken a stab at some measures and targets based on some input from Bill. about what we wanted to accomplish with each one of the objectives. So if we start with objective A for goal number 3, working with the Office of CFO on CERS specific annual reporting issues. So a measure of how successful that collaboration is, one measure can be communications with the external audit firm, and there's really 2 major points of communication with the audit firm. There's one at the beginning and there's one at the end. So the targets that I've described here would be those specific dates to make sure that we keep the annual reporting process on a timeline that gets done, gets certain key pieces done when we need them to be done. And then that third target highlights that we have a deadline for the Kentucky Finance Administration Cabinet. They are putting together the financial statements for the Commonwealth of Kentucky. All of that has to be submitted to GFOA by December 31st to get those certificates of excellence in financial reporting that we've talked about before. So CERS is one cog in that wheel. So we need to make sure that we keep our reports flowing to the Finance Administration Cabinet so that they can make their due dates for getting that annual award. So those are 3 key targets that I thought would be important. If there are other targets, happy to add those on this particular measure. And I'm going to make edits in the original document or in the Word document as we go along. So any suggestions for wording changes or changes in the measures or targets on number 1? Okay. The second measure focuses on that submission to GFOA for the Certificate of Achievement or Excellence in Financial Reporting. That's a very important timeline that we need to make sure of. The target is to get that award annually, one target. A second target would be to look at the comments that come from GFOA and make sure that we're incorporating those improvements into our policies and procedures. Most of those fall within the purview of Mike Lamb, and he takes care of those for us. So we're looking for any findings that might be more significant than others. But I've kept the wording generic here so that the committee can take a look at those comments and identify anything that we need to incorporate into our finance policies and procedures. Any questions or suggestions on that one? All right. If we go to objective B, this one is focused on policies and procedures for financial reporting. One measure can be described as providing essential information to assess accountability for CERS assets and the pension management. This is an area where I wanted you to make some notes as we were going through our financial statements. What are the key pieces of information in the financial statements that you track or that you go evaluate, you review when you're reviewing materials for these committee meetings? Are there some specific items that we need to add to some of these targets? Because what I have here is a generic listing, but we could make these more specific if the committee wanted to. I also linked this particular measure to the goals and objectives in number one, the actuarial committee. The actuarial committee is working on full funding and their definition of full funding, their analysis of the actuarial financial position. So there is, I think, an important link between finance and actuarial results. The second measure was looking at financial reporting metrics in the annual and quarterly reports. From my perspective as a financial manager in the governmental environment for a few years, there are certain key indicators that I look for in a financial statement for a governmental entity. Our financial statements are a little unique in that we don't have the significant liability on our financial statements. Those are incorporated into the actuarial reporting. The finance committee can collaborate with the investment committee, but the big chunk of our financial statements is the investment portfolio, and that's managed separately by the investment committee. So I didn't think it was beneficial to have finance duplicate any of their efforts. I've highlighted all of these targets because I think it would be more beneficial to have ranges or benchmarks in each one of these targets. For instance, how do we want to define growth for employer and employee contributions? What's good growth? What's negative growth? Where is there a concern? The target should highlight a point where the finance committee could evaluate either a policy or the specific performance to dig down and find out what's causing an actual result that varies from the target that we want in this particular item. So this is where I'm open for suggestions from the committee. What are you looking for in growth and how do you define growth for contributions? Is my microphone turned off?
No, Betty, I'm just sitting there thinking through that because, I think one of the things that determines that has got to be your funding level. And, we're basically legislated to have this thing fully funded by 2039 or 49, whatever it is. Would that not dictate to some degree what you would consider good growth, bad growth, adequate growth?
It could, but I think contributions are directly linked to compensation levels at local governments, at least for the CERS employers, our compensation and our head counts at the local government level. Full funding is an actuarial goal, but if we're trying to monitor employer and employee contributions, then I think we need to be looking at the relationship between contributions and the demographics of the system. Mike Lamb gave us an explanation today for why employee contributions went up, but employer contributions went down. And the underlying factors were important to that analysis. So when we're looking at it from a financial perspective and on that cash flow schedule that we use on a regular basis, how we compare the contributions this year to last year.
Would that not be a better metric to target, to monitor? Because we really don't have a whole lot of control over what our member organizations do as far as their employment, much less their payroll. how it impacts that cash flow would probably be a better metric, would it not?
I was thinking in terms of being able to monitor not just the change in the contribution level, but how the contribution level matches up with the demographics, the head counts and the salaries. Mike Lamb and I have talked a little bit about additional information, additional tables that we could put to provide some more perspective to that cash flow report, much like what he gave us in a narrative today for explaining why one went up and the other went down.
Yeah.
Not that we can control it, but if we see a trend that is concerning, or we see a trend that is very positive, then I think we can look at policies in our maybe in our actuarial strategy. We can see those trends and see how those trends might affect the overall performance of the system.
I don't have a problem with monitoring any of those, but I would add that cash flow as part of that we would monitor. If we're still sitting there at 1% negative cash flow, I don't know that I see a big problem on the other fronts, but if the other fronts are causing us to be 3% negative cash flow, that's a whole nother item, not to mention how that's projected to go forward actuarially.
And that's where I think it might be important to look at separate tiers. I would expect that the tiers are performing dramatically different from one another.
I agree with that. I think that's
And we would need different benchmarks for tier 1, tier 2 than we do for tier 3.
I think that's certainly a valid thing to be looking at.
So a target is not really monitoring as the verb. A target is a number or range or a condition that exists. So we need to reword these particular targets because they're not targets. They're action items.
It's like benchmarking than anything else, right?
Right, yeah. And we might not want to establish benchmarks for all of these or any of these or some of these. But I do think we need to reword them so that they are quantitative and not action items.
Yep. Okay.
Betty, I see this crossover with the actuarial because your benchmark and your monitoring, it seems to be, would be your assumed growth in employee numbers. The 2%, I think, is our assumed growth in number of employees per year, as well as a percent of growth in payroll. So if you want targets, I would think that those were the two targets you would need, because that's what our whole 30-year plan is based on, and we need to know whether we're falling short or exceeding that throughout the year.
I agree, and I think the actuarial goals, objectives, measures, and targets are doing that. From the finance perspective, we could, for instance, evaluate growth, or we could compare growth to the employer demographics to determine what that growth in contributions was. I've lost the verb I want to use. That the growth reflects the underlying demographics at the employer level. And that's something that we can do on the finance side. We talked last time about adding back in that table of retirements, changes in inactives and so forth, and Rebecca is working on that for us. But so one target might be that the growth in contributions reflects the changes in employer demographics. That's a target.
I don't understand the difference between that and monitoring, but I defer to.
Monitor says, I'm going to look at it every single time and I'm going to watch it, but it doesn't, monitor doesn't have a quantitative perspective to it. Where if you compare contributions to demographics, then you have a quantitative relationship between the two. If headcounts and salaries are going up, contributions should go up. And if they didn't, there should be a reason for it. And today is a good example because Mike dug deep enough to find out why one went down and the other went up.
Well, when we lower the rate each year, we should expect that kind of decrease in contributions unless it's offset by new hires or above the 2% raises.
Exactly.
Which is what Mike describes to us. I mean, we could graph it, but it seems like that would be monitoring. So I'm getting sideways with terminology.
Okay. Well, we can leave it as monitors if you guys think that's more descriptive.
I think between monitoring and the other things that we're benchmarking, we ought to be able to, put two and two together. So, yeah, it's not difficult to figure out, particularly this year, why, things, why that contribution number went down. But if you look at the actuarial tables, projected contribution rates going out forward, you see that we're kind of in that sweet spot that assuming we hit all our other, return targets and whatnot, we're probably not going to see much variation in it at all until we hit full funding. When I say not much at all, I'm saying it stays within 2 points contribution wise, barring anything coming out of the legislature that changes that narrative.
Well, I think one of the objectives on lowering the contribution rate was to give employers more capacity to A, hire more staff and increase their head count, and B, provide better salary adjustments. So there should be a certain amount of offset to it, and we might want to keep track of whether or not that lower contribution rate is having the effect that we hoped it would have, which would be a higher head count and a higher salary level.
Seems to be happening, but I would put at the top of that list before you got to that we still reach full funding by 2049. Because that's really the mandate.
Well, that goal is in the actuarial section of this report. I think that is goal 1. Sherry, if you'll go to page 53 of board books. That is objective C of goal number 1.
And I think, we need to talk about rewording that to it specifically says reaching full funding by the target date.
And we have January 2038 as the target.
Yeah. Yeah. Anyway, whatever.
So wording on goal number 1, we can discuss at the board level if we want to refine those.
Yeah.
I think my point is that's an actuarial goal, not a finance goal.
If you've got, there's one item I didn't see in there, and it's just something that's kind of reared its head, Betty, that I'd like to have the committee, have a short discussion on, Bill. Is having some type of reference to the procurement policy and procurement process, particularly as it pertains to something that's exclusively a C item. I think, I think Bill and I have talked about having some type of representation in that process. So how it's worded, I'm open to whatever, but I think that's something that needs to be on the finance committee's plate to address.
We could add a measure under objective B for thinking as I'm typing, enhance CERS representation during procurement.
When the procurement process, I think that, Bill, kind of what you're thinking.
Well, I don't, I think these are all things that need to be discussed. I don't know that they need to be an objective for a 5-year plan, but I mean, the wording is escaping me, as all strategic plans do. So this is my weak point.
I think the targets or timeframes or whatever, are certainly up for debate, but just to have it on our plate, I think it'd be worth keeping it out there so that, whether it's a year from now, 6 months from now, or 3 years from now, it doesn't slip through the cracks.
Well, let's put in a review of the purchasing procedures and policies and procedures as it affects CERS, and have a target to have the analysis concluded a year from now. Is that a target?
Yeah, I think that's good.
Yeah, I'm trying. Well, words not cooperating with me here. Hang on. I'm trying to type as you guys are talking. Complete analysis of CERS procurement functions within a year.
As it affects CERS.
Right. Complete analysis of CERS procurement functions within a year.
Yes.
The measure would be enhanced CERS representation during the procurement process. Sherry, if you could let me share. Let me pull this down so I can get.
I would say clarify. I don't know that it's an enhancement.
Okay, clarify.
Until we do the analysis.
Okay, clarify. Got it.
And you should be able to share, Ms. Pendergrass.
Okay. All right, so now you should be able to see the number 3 measure that I added, clarify CERS representation during the procurement process, and then the target is complete analysis of CERS procurement functions within a year. Is that what you had in mind, folks?
Satisfies me, Bill. Does that follow your?
Yes, we'll start the time clicking going forward from now.
Objective C is establish an escalation policy for the Office of CFO regarding policy decisions for the committee. I've got the CFO identifying metrics that might require special attentions. And I've left blank the targets because I'm not sure what we're looking for here.
Well, I believe Mike Lamb already has this in process. And so, Mike, do you have any suggestions on wording for either the objective, the measure, or the target? I'll put them all out there for you.
You know, if we want to specify things specific to the admin budget that needs to get escalated or reported, I could see that. I mean, I do that now, but it's, you know, it's pretty much informal. It's based on my judgment of what should be brought to your attention. And maybe there could be a metric of, you know, items that are more than 10% above planned budget for the quarter or whatever might be something that needs to be brought up in the meeting, right? That's easy to do. You know, outside the admin budget, there may be some other items that are relevant to the CERS Finance Committee, like, you know, even audit statuses or, you know, even the procurements that relate that could affect you, the external audit procurement. Those are KPPA type procurements, but they have an impact to CRS, and maybe there should be some targets that somewhat requires me to bring them to your attention, if for whatever reason. I'm open to a lot of things. I don't think this is a heavy lift. If we just specify some ranges or items that give me some guardrails on what to bring to you.
So if we did administrative budget categories that exceed 10% seems kind of low. You're giving us all that stuff already. What about 15 or 20%?
Yeah, the bigger the better.
So
Betty, how about this? 20% per item line, but 10% on the
total.
overall. Yeah.
If we do category, I'm focused on his summary table that gives us some line items for personnel, and then some consolidation on the operating side. Let's see, Sherry, if we go back to looking for the page number. Yes, if we go to page 32 of board books. If we use 20% of the budget to actual summary line items, or 10% of total administrative budget. And another item might be critical issues related to annual audit or financial, better word, annual audit or financial reporting. And we could use the same 20 and 10 on the investment budget, expense budget. Does that make sense?
Makes sense to me.
Okay. All right, then that would take us, and I'll clean up the formatting a little later before I bring it to the board. And then the last one is objective D. And it is focused on regulations. I assume that meant the Kentucky administrative regulations. I worked with this one a little bit to try to refine it, but leave it in general terms. We already have staff who are focused on reviewing administrative regulations. I didn't think that Finance Committee needed another ad hoc group, or CERS certainly doesn't need another ad hoc group. But if we rely on their work, then we could evaluate whether or not those regulations are working. If employer compliance and timely reporting continues to improve, like we saw this month with significant decreases in the outstanding receivables, significant increases in the number of paid invoices and so forth. And then I added a survey of employers to get some feedback from employers in terms of their satisfaction and understanding of both statutes and the administrative regulations, based on how we are communicating with employers about their responsibilities and their compliance. And then I've got a measure for ERSI and KPPA communications that clearly highlight and explain changes in employer responsibility, and a couple of targets to go along with that. That gives us a catalog of employer communication material that Duane and his staff can use to for training for employers. And we have a process for pushing out those new administrative policies in employer communications. And I see this more as a support role, because those primary responsibilities fall to ERSI and other KPPA administrative staff. We can request things from our perspective, but we certainly don't supervise either one of those. Any questions, additions, edits in that section?
I think that's fine. We can facilitate better communication, all the better.
Right. I'm a firm believer in communication and education to improve compliance. I've seen it work very well. And I expanded the list on goal number 3 and how we will evaluate success. So this is just an overview of the key items that we want to accomplish from a finance perspective. Any suggestions for edits in that section? And then the very last piece is the timetable. And this is for goal number 3. This is just a list of the 4 major objectives. The annual reporting is ongoing. I put a completion date for 2026 on the reporting policies and the escalation policy. And then employer participation policies, I think, are also ongoing. And with that, I believe that's all the fun facts I know and tell to bring to the committee, Mr. Chair.
Thank you. Anyone else have any strategic plan questions, clarifications, suggestions? It's a regular meeting. Does anyone have any other items to bring before the committee?
Need to make a motion to approve this, to send it on into the full board and the full strategic plan.
Do I have a motion?
So moved.
I have a motion. Do I have a second? I have a motion, a second. Any further discussion? All in favor, please say aye.
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 Okay. Any opposed? So moved. Now, since any other items before the committee, we're almost out of time, but anyone have anything? Hearing none, I want to thank you and members of the board, as well as all of the administrative staff for all their support to have this meeting. And I call the meeting adjourned. Thank you all.